And that is where the dividend trap comes into play. What I'm going to do is show you two ways to find dividend stocks that outperform the 1.5% average. I'm going to show you the gambling approach and I'm going to show you the investment approach. People often get those two confused, which is why they end up losing everything. But I'm going to show you each of the approaches so you know what you're looking for and you can recognize it. Hi, it's Dre Griggs with Lucid Wisdom. Today, I answer the question, how much do I need to retire off dividends? I actually get dividend questions kind of often because a lot of people are like, hey, look, I hear all these great things about dividends. How do I get started? So there's a couple things that I'll show you in this video. One is there's a very quick 3-step process that you would need to be able to know how much you need to retire off dividends. Also, I'll show you a couple of the pitfalls that people tend to run into when they're trying to figure out which stocks to invest in. And I'll even show you a couple of dividend traps that will catch people where they end up losing a lot of their money. Most of the time, people are uncomfortable investing because we've either lost money, we've heard about someone losing money, or we just have this general fear because we don't understand the stock market. So this video is intended to help you have a realistic expectation and also to be able to know what you're looking for when choosing a dividend. So first and foremost, let's go over the 3 steps that you need to know. The first one is how much are your expenses? When it comes to the levers of determining how much we need to retire, that number differs depending on the lifestyle that you have. Studies show that we tend to retire on about 80% of our income. That implies that we're going to maintain a certain lifestyle that we already have. We're probably going to live in the same area as far as cost of living is concerned. And then it gives us a great place to start. Now, if you're someone who says, you know what, Dre, I'm going to pay off all of my debt, then you can average a lower retirement monthly expense because you're going to have all the debt paid off. If you're someone that says, you know what, Dre, I'm going to go gangbusters, I'm going to have the best retirement lifestyle, I'm going to travel, I'm going to do all these amazing things, then you probably have to have an increase in your overall expenses that you currently have. And then naturally, when you take into consideration not only the lifestyle that you have, but where you're going to live at, how expensive it is, you should be able to come up with an average number. Now, for someone that's not sure yet exactly what your retirement lifestyle will look like, I generally tell people, let's just go for 100% of your current income. That's a great place to start. We can ebb and flow, adjust, increase, decrease from there. It's just a good place to start. This is where I'm currently living at. If I wanted to retire in the exact situation I'm in now, how much of my money needs to be working so that I can stop working? Two is you have to identify your desired dividend yield. Your dividend yield is a very fancy way of saying how much is the stock price compared to how much the dividend payout is. So for example, I give us nice clean numbers. If the stock price is $100, then to have a 1.5% dividend yield, that would mean that they would need to pay out $1.50 in dividends each year. That would give you 1.5% dividend yield. If you have a $5 payout on the same $100 stock, that means you have a 5% dividend yield. And then naturally the number goes up as well. So if you had a $10 payout each year from a stock that is $100 and you have a 10% dividend yield, whatever your desired or target dividend yield is, that's a very important number because it lets you know how much money you need to have invested. For example, the stock market on average is about a 1.5% dividend yield. That means you would need about $2.6 million invested to maintain a $40,000 a year lifestyle. Now, the good news is that is an average. So that means there are stocks that pay a higher dividend yield. It means there are stocks that pay a lower dividend yield. And that leads us into our third and final step where you'll calculate the required investment that you need to have. So let's assume within our retirement plan, we only need $40,000 a year to come from our dividend investments. So if you need $40,000 to be covered in that, and then if you had the average, which is about a 1.5% dividend yield, you would then divide the $40,000 into 1.5%, and then that would get you $2.7 million. Now, $2.7 million tends to be outside of what most people have saved in their retirement plans. In fact, I think it's about 10% of Americans as a whole are considered millionaires. So if you have the 2.7 million that you need to maintain a $40,000 a year lifestyle, you may say, Dre, I don't think that that's a good way to use my money. I don't think that's going to work very well for me. And I can understand that because it is, again, only a 1.5% yield. Now, the thing is, if you find stocks that have a higher yield, then you need less money. For example, if your dividend yield was 5%, where every time you invested $100, they gave you $5 back in dividend, that means you only need $800,000, which is more than a third lower than that 2.7 million that we had calculated with the 1.5% dividend yield. So you can see that just by increasing your dividend yield to 5%, which is not impossible, you're able to significantly cut down on how much money you need to have invested for you to be able to live off that dividend. Now, I know what you're thinking. You're thinking, okay, Dre, if 5% does that, then maybe I should find a dividend that pays 10, 20%. And I understand what you're saying. Now, simply for the sake of the numbers, if we had a 10% dividend yield where every time I invested $100, $10 came back to me, then you would only need $400,000 to live off of $40,000 a year, which sounds really good when you think about it. If I have the average of the stock market, which is 1.5%, then I would need 2.7 million. But if I found a stock that has a 10% dividend yield, now I only need $400,000. Again, that is a significant reduction. That's literally a seventh of what the other number was. And that is where the dividend trap comes into play. What I'm going to do is show you two ways to find dividend stocks that outperform the 1.5% average. I'm going to show you the gambling approach and I'm going to show you the investment approach. People often get those two confused, which is why they end up losing everything. But I'm going to show you each of the approaches so you know what you're looking for and you can recognize it. So the first one is Zim Integrated Shipping Services. And you'll see that this stock actually paid a dividend out of $6.40. And that would give you a dividend yield of 233%. So you're looking at this, and you're like, well, wait a minute, Dre. If what you told me earlier was true, that if I only had a 10% dividend yield, then I would only need to invest $400,000 to live off of $40,000 a year. Then what you're telling me is if this stock is paying a 233% dividend yield, then I don't have to invest that much at all. And you'll be right based off of this number, because again, we're talking about 200%. That means every time you put $1 in, you get $2 back. So as far as your required investment is concerned, you would only need to invest $17,000 one time to be able to be paid $40,000 a year for the rest of your life, assuming that the company exists the rest of your life and they maintain these payments. This is what we call a dividend trap. You should never be just chasing dividend yields, because there are companies out there that know that people are just looking at the dividend yield and they're just going to change their filter to highest, and then those are the stocks they're going to buy. And so if you have a 233% dividend yield, there's going to be a lot of people who are interested in that. But we would call that gambling. And I'll show you why. There's a couple things that you always want to keep track of. Number one is if you are investing in a company, like if you choose one single stock that is going to pay a 233% dividend yield, that means you have to put in more research ahead of time to make sure that you're not being taken advantage of. And so you can see when we take a look at this, there's a couple things that I think would be considered red flags, or at least something that you'd want to be very cautious about. First and foremost, obviously paying a dividend yield of 233%, where you're essentially going into debt to pay out the dividends. That's not normally a good sign. Next, this was a shipping company that was started January 29th of 2021. Well, what was going on around that time? Around that time, we were dealing with COVID-19, and there was a huge logistical problem where everybody was trying to get supplies and they were willing to pay any price that they needed to get their shelves full again. As a result, when this stock first came out, naturally in that environment, everybody's going to make money. It would be the equivalent of you investing in a mask making company right around the time of COVID-19. It would be the equivalent of you investing in a hand sanitizer company around the time of COVID-19. Sure, that makes a lot of sense in the moment, but you and I both would agree that can't last forever. And when you're in logistics and you're a company starting around the time of COVID, you can only expect it to go up. And you can see it increased to $84.50. That is phenomenal. So this stock came out at $12 January 29, 2021. You can see that it increased up to $84.50 a year later now, just a year later. So March 18th of 2022, it was $84.50. If you invested in that, if you were getting your 200% dividend, you felt like you were on cloud nine. Everything was going as great as it possibly could have. But then you'll notice what happened the second year from 2022 to 2023. You will see that it went from $84.50 to significantly lowering to where it's at today, which is $8.06. If you invested in the stock because it was paying a 233% dividend, then you have opened yourself up to what we would call the dividend trap. It is unlikely that this company is going to maintain the same dividend payments 10, 20, 30, 40 years from now as you continue in your retirement. It's most likely that they'll only do it for another year, maybe two, probably three tops if they plan on maintaining the business, because you cannot promise to pay a dividend of $6.40 per share, knowing that your stock itself is only worth $8, which means your earnings per share is probably only worth a couple bucks. So you can't possibly be paying out something that's 2, 3 times your earnings per share and expect to be able to reinvest in the company and to grow the company, right? That just doesn't make sense from a business operation perspective. Another red flag for most investors is this is actually an Israeli company. It is not as much the fact that the company is in Israel or any other foreign country. It is the fact that if you're investing internationally, those are generally going to be riskier stocks because there is a political climate internationally that's a little harder to control. We haven't even discussed the way the courts are and the laws and intellectual rights and just everything that has to do with investing in a foreign country. Everything that has to do with investing in a company is 10x when you're talking about investing in a foreign country. Now you have to investigate how that country treats businesses, whether that country is stable enough, whether the corruption is low enough. And when you look at Israel, you're well aware that there's a war going on right now. How does that impact your investments in that particular business? There's so much that we don't know when it comes internationally that just puts an extra layer of due diligence that the average retiree is not interested in doing. So for most retirees, you want to stay within domestic companies because those are a little bit easier to keep track of. There's lots of research on those stocks, so you have a better feel of whether you're choosing the right company. Now, what some of you may be thinking is, Dre, what you're telling me is if I'm outside of the 1.5% average, then that means it's probably a scam and it's something that's not going to last. And I don't want to be caught in a dividend trap. But what I will do is I'll show you another example that I think will help you feel a little bit better when it comes to just finding stocks that outperform it. I can put a list together for you and I'll tell you some of the things that I look for when it comes to making investments for retirees. And this list in particular, what it does is I look at the 5-year average. So what we're saying is we're going to look at the compounded percentage increase in dividends from 2018 to the current 12-month indicator rate, which is just saying what is it projected to give out in dividends this particular year. They also will need to have increased their dividend payments each year from 2018 to again 2023, with 2024 also looking to have at least a 1.5 times dividend coverage rate. And that's a very fancy way of saying how many times can a company pay dividends to its shareholders using its net income. We're trying to avoid companies that are taking out debt to pay the dividend. That's normally a red flag. I don't want a dividend if you have to take out debt to pay it. Ideally, you would like the company to pay its dividend from the profits. That's not a requirement, but it is something that I normally filter for when I'm searching companies for people retiring. Normally, we're also looking for companies that have a 2024 estimated PE ratio, that's a price to earnings ratio of less than 20. And all that means is how much money do I need to give the company to receive a dollar back in earnings? So if you have a PE ratio of less than 20, that means that every time I give the company $20, then I should get at least a dollar back. And I'm going to make sure that that PE ratio is actually increasing from 2023 to 2024. And the last thing that I'll add is I want it to have at least a 2% dividend yield. And so what you'll see is we put the work in when it came to putting our list together of companies. We don't have 100 companies to research. This is a very particular list that is going to help you to limit the amount of stocks that you even have to put any research in. Now, granted, most companies, when they make it past this, we have 5 years of a proven track record of paying out dividends at an increasing rate, where you have a price for earnings of less than 20, a dividend yield of 2%, and where you have a dividend coverage rate of at least 1.5. When you think about a company like that, there is value already established in this type of a company. And I'll give you a few examples of companies that will outperform the average of 1.5 without you feeling that you're putting your money at risk, where we're talking about investing versus gambling. So first on the list, we have Voya Financial, and you'll see that Voya Financial checks off all the boxes. And so you'll see it has a dividend yield of 2.4%, which you already know is a significant benefit to have an additional 1% over the average, because now you don't have to put as much money in to maintain your retirement lifestyle. Next, we have MVB Financial Corp, and you'll see that they have a dividend yield of 3.5%. And they check off all the other boxes that we have. So we've already filtered for it. So we're already looking pretty good. They have a PE ratio of 9.3, and I'll put the numbers up so you can see it. You have Solaris Oilfield. They have a dividend yield of 4.8%. So about 5% of a dividend yield for Solaris Oilfield. And again, the same things as a 5-year proven track record, paying a dividend out. It's increasing, but it's not that they're paying it out of debt. They're paying it out of their net earnings, where the net income coverage ratio is at least 1.5. And I'll give you 2 more stocks. And so you'll see Blackstone Inc. has a dividend yield of 3.5%. And the fifth and final example, Premium Brands Holding Inc. has a dividend yield of 3.5% as well. And has a PE ratio of 11 with an estimated earnings per share of 2024 to be about $6. And so what you can see is we're able to put a plan together where we outperform the 1.5% average return that people have in dividends, where we're now able to say, well, I don't need $2.7 million anymore to have $40,000 a year coming in retirement. Now you set it up in a way where we can get away with only a third of the money invested, where you could probably get away with maybe $800,000 in dividends to be able to live off of $40,000 a year, because now you're averaging closer to a 5% dividend yield. But you didn't have to sacrifice the quality. You're not just out there gambling, hoping that this company is going to be around in 40 years. You're picking companies that have a nice 5-year track record. Now, granted, if you're more conservative, then maybe you need to have a 10-year look back. But depending on how many stocks you want to have inside of your dividend portfolio, that may be too conservative, where you need 10 years track record. That's really hard. It's not impossible, but it just gets a little more difficult. But 5 years is a really good time, because also keep in mind that means it included COVID. So these companies performed well during COVID, where they're able to keep paying out the dividend. They're able to keep increasing the dividend. They still have equity and value inside of it as far as the PE ratio, how much my money is getting me back in earnings. And then you see that they're not overexposed, where they're putting too much of their money out from their net earnings, so they can still reinvest in growing the company. Basically, what I'm trying to show you is investing in stocks is just the same as buying a company. What kind of company would I want to buy if I met with the owner today? They sat across from me and they told me how the company was doing. I would want a company based off of the filters that I gave you, not a company that's explaining to me how they're making $2, but they're paying out $6. You and I will both look at them and be like, I don't know if that math is mathing. And that's probably also part of the reason that Zim is not performing well. Obviously, we're not in COVID anymore, so they're going to come off their highs. The same happened with Zoom and Roblox. If there was something that was driven by the environment, when that environment changes, kids are going to go back outside, so Roblox stocks are going to go down. People are going to go back to work, so Zoom stocks are going to go down. And when you're just dealing with a bubble, which I generally would call speculation, which is gambling, I'm just going to invest in this because right now it's going to do great. Now, granted, if you want to time the market and you're someone who feels like you know exactly where the peak is going to be and you're going to sell it right there and you're going to make all the money when everybody else loses it, good luck with that. The numbers show that that doesn't work for the average person, because we just don't have the time or access to the information to make such a calculation. Well, that'll do it for us today. I just want to thank you, as I always do. I do appreciate your time. Thank you for subscribing. Thank you for watching these videos. If you find value in it, I simply ask that you like and subscribe so you can continue receiving valuable information on how to close that investment gap through wealthy retirement planning. Until next time, stay safe and enjoy life.